Hey guys, welcome back. This memory trade continues to be fascinating. It continues to show us that it is at the heart of the AI infrastructure build out. In tonight's video, I want to show you two different things. I want to show you an updated report from TrendForce that just shows us how memory prices are soaring and the percentage of the CapEx spend in 2027 that will account for memory. The cloud service providers better hang on because they're going to have to spend a big amount to get the advanced memory products that they need. And secondly, let's talk about the contracts that are in place, the long-term agreements that have been set up by all of the memory providers, particularly Micron, Samsung, and SK Hynix. But there are some differences in these contracts. There was a great article today in Barron's that talked about how one of these, the differences in these contracts could account for some of the companies in their ability to capture more of the upside potential in pricing versus the others. So let's dig into the contracts. Let's talk about the differences and let's decide which one is the best for our individual portfolios. And finally, we'll end tonight's video by talking about the 5 stocks that I think are poised for a breakout after Nvidia drops its earnings on the street tomorrow. And guys, like I said yesterday, I expect it to be a beat and raise tomorrow afternoon. And I think these 5 stocks that I'll show you at the end have an opportunity to soar after Nvidia shares their earnings, their outlook for the future, and the demand that they see in the marketplace right now. So that's what we're going to cover tonight. If you haven't done it, though, make sure you hit like. Make sure you subscribe to the channel. Let's jump right in. Let's take a look at what we saw with Micron today. If you guys remember from last night's video, I mentioned I thought we would see Micron start to kind of have a bit of a sideways digestion overall. I just thought we would get into this period where it would fluctuate between 915, 920 overall. And it's basically what we saw throughout the day today. I thought it would defend that 905, 907 support right out of the gate in the opening. And I thought it would continue to just have this sideways digestion between 918 and 922. And I mentioned if it could break through 922, that it had an opportunity to gap up to the 935 level. We almost got there today, but it certainly was much more of a bull scenario today than the bearish one I went through last night. You can see it in the candle pattern chart. Strong gap up right out of the gate. We actually got up to 946 today at the opening bell. Had a little bit of profit taking, a little pullback, but then the stock showed some resilience, got back up to about 935 and just got into this digestion period as I thought it would, between 918, 915, 920 overall, but had a strong kind of finish to the end and a couple of really nice candles that closed the stock at 932.50. In the after hours right now, we're seeing it down by 0.5%. So we'll keep our eye on it as we move throughout the night. But tomorrow, everything will be set up for Nvidia's earnings that they drop on the street. But right now, today, I want to talk about this article that TrendForce put out, because they're talking about how memory prices are soaring and they're set to soar into 2027. You can see the title on the screen that DRAM and NAND to account for 68% of major cloud service provider CapEx in 2027. If we go through some of the details of the article, you can see that it mentions that according to their latest memory research, that major global cloud service providers are accelerating AI infrastructure investment, with total CapEx projected to surge 98% year over year in 2026, and then another 50% in 2027. The rapid increase will be driven in part by soaring memory contract prices and a robust procurement demand. Let's go through some of the details. This graph highlights just the growth in CapEx across the world's 9 major cloud service providers. You can see the exponential growth from 2024 to what we expect to see in 2027. TrendForce observes that the sharp rise in memory contract prices since the second half of 2025 have significantly increased memory share of just spending overall for the cloud service providers. Server DRAM saw contract prices rise by a cumulative 64% in the second half of 2025, and a further jump of approximately 270% is expected this year. And we're also seeing a very similar trend with NAND. And its enterprise SSD prices are rising by 35% in the second half of 2025 and is projected to surge by a cumulative 235% this year. So these long-term contracts that were signed in the second quarter of this year and moving forward onward, we know they're for 3 and 5 years overall. They've included price ceilings that could limit further increases. So nevertheless, HBM contract prices could still rise 70 to 140% next year. I'm going to say that again. It could rise 70 to 140% next year, according to TrendForce. And on top of the higher prices, we're seeing rapidly growing demand for memory bits from the cloud service providers. In 2027, process migrations and capacity ramp-ups at new fabs in the second half of the year are expected to drive a 27% increase in combined server DRAM and HBM bit supply. But look at what this sentence right before that. TrendForce estimates that HBM and RDIMM combined will account for 51% of the DRAM bit supply this year. So TrendForce also indicates that rising memory contract prices, particularly for HBM, combined with the higher bit supply, will push memory share of the cloud service provider CapEx to 68% next year. So think about that. For every dollar spent, 68 cents of that dollar will be memory. That's how much the memory prices will soar next year. And that's how much just leverage and power that these memory providers will have in the market that they have today, but also what they will command next year in 2027. And that's going to lead to 2 implications they mentioned. First, elevated memory costs could provide server and AI chip suppliers such as Nvidia. It could provide them with greater justification for raising product prices. And alternatively, we could see cloud service providers be more aggressive in optimizing the AI system memory architectures through the ASICs overall, through Broadcom, through other vendors outside of Nvidia, and they may also try to reduce memory capacity per system. So those are the 2 paths right now. Clearly, that could happen in the marketplace based on what we're seeing with pricing right now and how it's potentially just positioned to soar next year overall. So in this type of pricing environment, I want to show you this article I read in Barron's, and then we'll dig into the contracts more, because I think the piece we have to ask ourselves in this type of environment where it is booming and hyperscalers are actively searching for ways to cap their exposure right now to memory overall and the costs associated with memory. It brings us to the investment battle. And that's why I made the thumbnail the way I did. You know, Micron versus SK Hynix and the contracts, the difference between those contracts of those 2 key companies right now, and which one is more positioned to win in this environment. So let's jump over and take a look at the Barron's article. And then I want to dive into some of the details in the contracts and give you my opinion about which potentially one could be positioned to win in different types of environments. So first, let's jump real quickly through the Barron's article. You can see here it says Micron stock rebounds, but it will miss out on 50% rise in memory prices. If we scroll through, it says the question of just how high memory chip prices are going to rise is in the mind of almost every technology executive. We just saw some of that evidence in TrendForce, what they think it'll be this year, what it'll be next year. So I guarantee you, it is in every mind. It's in every mind of a tech executive right now. Overall memory industry revenue is set to nearly quadruple to $837 billion this year, according to Gartner. They're set to climb by more than, when you take a look at Micron, this quarter alone, contract prices for DRAM, which account for about 3/4 of Micron's revenue, are set to climb by more than 50% from the current quarter. And when you take a look at NAND flash memory, it is set to rise even more pronounced at 60%. So Micron won't see all of that cash flow into its revenue because of its contracts and the way they set up. The company has locked in these long-term supply agreements with their major customers, which have set a ceiling in its prices in exchange for guaranteeing long-term margins and long-term revenue visibility. I want to jump into some of those differences and talk about it. But the first thing I want to show you is just how the players are positioned today, because SK Hynix, guys, as you know, is the dominant player in HBM. They are the undisputed titan in that marketplace. In DRAM, they're not as strong. Samsung dominates that market with a 39% market share. We know Micron has a 25 share. They actually moved up from 22% to 25 in the most recent quarter. They're right behind SK Hynix, went at 26% in the second quarter of this year. But if we look at HBM, and this is based on the first quarter of this year, the new data for HBM market share isn't out yet from Counterpoint, but you can see the dominance that SK Hynix has here, almost a 60% market share in HBM, where you're seeing Micron and Samsung position themselves right about 21% overall in the market. You can see that growth. I mean, at one point, SK Hynix about a year ago had almost a 70 share of high bandwidth memory. So Samsung and Micron have definitely cut into that leadership, but clearly SK Hynix is the dominant player in HBM. So let's talk a little bit about the contract differences that we see, because as I mentioned, SK Hynix is a titan, but Micron is not a slouch. You know that. I love Micron. I follow it each and every day. I share the stories with you guys on this channel for a reason, because I think it is an excellent investment option. It's an excellent company in the U.S. marketplace that has a diverse portfolio and is meeting the demand in the market. And guys, they have signed 16 strategic customer agreements. They're spanning across the data center, consumer, as well as the automotive markets for them. These are 5-year non-cancelable take or pay contracts covering 20% of their DRAM volume and about a third of their NAND volume overall. And 14 of these agreements, they account for $100 billion in minimum contracted revenue, and it's backed by $22 billion in customer cash deposits and financial commitments. So there's significant investment behind this company. They are a powerhouse. But there are some differences in their contracts. And I want to show you what this article from TrendForce says. It says SK Hynix is now adopting contracts that eliminate the industry standard price cap, making a departure from Micron's approach. This is going to be the clear differentiator between the two. And it's going to have implications if the price of DRAM or HBM just decides to exponentially increase. SK Hynix is going to have a significantly more upside by the way they've set up their contracts. And I want to show you that. I have a graphic to show you in a moment as well. But SK Hynix's new structure allows spot market price increases to be fully reflected in contract pricing when supply shortages push market prices higher. And this effectively, for the long-term contract framework, it allows them to better capture profitability during upcycle conditions. We scroll down and take a look at Micron. It says, unlike SK Hynix, Micron, in their strategic customer agreements that they disclosed last month, they reportedly set the price cap for existing products at the second quarter of the 2026 market price. Now, we've seen Micron CEO. He thinks this is a fair price. It maintains the margins that they see are very close to the margins that they see today, but it definitely limits their ability to capture rapid upside in their pricing and drive more pricing power in the market like they have before these contracts. And also, they won't be able to do it at the same rate their competitor will be able to do it, because we could see a real clear differentiation between the two companies as we move forward. But Micron's their contracts include binding volume commitments while also setting an upper price cap tied to the prevailing market levels from April and June of this year, alongside a contractual price floor applied over the full term of the agreements. So let me jump over and just show you some of the differences in this graphic. I think it calls it out well. But you can see on the left is Micron. On the right is SK Hynix. So if you look at the spot pricing, which is, we'll call it that lightning, that yellow kind of trend arrow that's moving up. You can see this represents the spot price for DRAM and NAND. We have the revenue floors baked in there, but we also have the contracted price ceiling in there. So as these prices, if they move exponentially higher, it does cap the opportunity for Micron to capture on that upside that we could see in pricing for the market. It's, SK Hynix has it a different setup. So they capture maximum upside due to uncapped exposure at spot market spikes. Micron's revenue, it is restricted by contracted price ceilings. So you can see the clear differences between the two. And you can see once we get above that blue dotted line here on the Micron side, that is all unrealized revenue of there as that spot prices move higher. But SK Hynix doesn't have that. They have a more of a kind of opportunity to capture a floating contracted price overall. So they have a full upside capture, a variable downside. It's not a secured downside like Micron, but it is a variable downside. But you can see, and based on what TrendForce put out there, that we expect the prices to soar in 2027. And as it's set up right now, SK Hynix, you can make the argument, is much more positioned with their contracts to take advantage of those soaring prices overall. So Micron's their contracts, they have a defined price bands. They set a price floor below which the rates cannot fall. They're eliminating the multi-billion-dollar drawdowns that have historically plagued the memory cycle. So they are taking away, in a sense, this fear of the boom and the bust. The floor protects Micron if the cycle collapses. It doesn't protect SK Hynix in the same way that Micron is protected. But the ceiling can limit Micron's participation in an extreme upside pricing environment. Micron has effectively exchanged some potential pricing opportunity for something that the industry has almost never had, which is a multi-year volume commitment and margin protection and an extraordinary earnings visibility. And that changes the questions for us as investors. We know these contracts do that in the first place, but we are no longer asking whether the memory pricing is strong because we know it'll be strong. TrendForce has shown us it'll be strong. What we need to be asking right now is who captures the economics the best when memory pricing becomes extraordinarily strong. That is a very different story for this sector because for decades, memory investors feared the prices collapsing. Micron responded by creating these long duration take or pay contracts with pricing floors in it, as you see on the screen. But if HBM or if DRAM pricing suddenly rises 50% beyond expectations, some contracted volumes within Micron's contracts will not participate fully because of the ceiling that they have baked in. So Micron has effectively traded the maximum cyclical upside due to this, how prices could rise and they could spike. They've traded that for a minimum guaranteed profitability and revenue visibility. And that gives investors a fascinating question to consider. The question would be, did Micron successfully de-risk the memory cycle, or did they accidentally cap part of their upside during the greatest pricing environment in memory history? So therefore, these contract structures could become a meaningful differentiator between the key memory providers, and potentially it sets up or opens up a much bigger follow-up analysis around which memory company has negotiated the best contract for this stage of the super cycle. And so it makes you ask a question of which model or which contract framework wins, or which one is best for our portfolios? Would it either be SK Hynix maximum upside with very limited downside protection, or is it Micron's structurally risk-adjusted machine that they have in their contracts? I would say this: if you believe that the hyperscalers will pay any price for memory without altering system configurations, then clearly the SK Hynix contracts offers a pure leverage for the runaway price spikes and significantly more pricing power in the marketplace. However, if you think TrendForce's that warning they had in their article comes true, that memory, since it claims 68% of the CapEx for the cloud service providers, if you think that they will begin to negotiate price ceilings or redesign hardware, then Micron is the superior risk-adjusted holding for your portfolio. Their agreements guarantee fixed volumes, protect profit margins with their price floors, and provide unmatched earnings visibility straight through 2027 and beyond, in some cases out to 2030 overall. So that's what I wanted to talk about. There's a clear distinction right now, but I just didn't want this video to be only an academic contract discussion, because we have the biggest earnings happening tomorrow at the close of the bell when Nvidia drops their quarterly earnings on the street. And I think that clearly there are going to be winners and there will be losers. As I mentioned, I do think it'll be a beat and raise across the board. And I think there'll be 5 stocks that are poised to win once they drop their earnings on the street. And I want to show you those 5 that I'm calling, and you can we'll track it tomorrow after they drop them on the street. But you can see across the board, I'm ranking it from 5 to 1, 1 being the strongest. But I do think Dell has a great opportunity to drive price action after Nvidia's earnings on the drop on the street. They are primarily the vehicle turning Nvidia silicon into fully integrated AI server racks. TSMC is an obvious choice. They build what Nvidia designs. Their CoWoS is a critical packaging bottleneck for all AI chips. They're the leading 3 and 2 nanometer capacity at max utilization. I think Broadcom also has an excellent chance to drive price action after their earnings. They dominate the high-speed Ethernet switching and optical interconnects. Their custom ASICs business is accelerating, And we see with larger rack architectures, Broadcom is incredibly important. Vertiv, I think, has an opportunity to move after the earnings drop on the street. They're the leader in thermal management and power infrastructure, as well as liquid cooling, which is mandatory for next generation AI racks. So I also think Supermicro could have a chance to win, but I chose Vertiv out of those two. And then finally, Micron, I think, is the highest beta choice for me on a stock that can win after Nvidia's earnings when they have a beat and raise. It's clearly because the HBM capacity that they have, the importance for HBM to the AI build out, the importance for Nvidia, the HBM4 rate, they're projected to have 20% of the architecture for Nvidia. That's something I want to listen to when the earnings, when Jensen goes through the earnings tomorrow overall. But we are seeing memory continue to be a massive demand driver in the market. They just have an opportunity to continue to drive strong performance. Honestly, guys, not only through this year, but in the next year to come as well. But I think Micron has a great chance to drive strong price action after those earnings drop on the street tomorrow. So finally, the market continues to treat memory in some ways. Many investors, and I would say the market, treat it as a short-term trade. But the data that we see and what we've reviewed together over the last few weeks, it shows us and confirms to us that memory has become the central engine of the entire tech ecosystem, and it will be a sector that will continue to be dominant over the years to come. They will dominate in the market. They have strong demand. And as I mentioned many times, demand is going to continue to outstrip supply all the way through 2027. So that's my thoughts for tonight. I'm looking forward to a great earnings tomorrow. I'm looking forward, hopefully, to see a strong run from Micron and the other memory providers up to the end of the closing bell when that earnings drop on the street. But let me know what your thoughts are, guys. Drop your comments below. Let me know what you prefer in the contracts that I walk through. Do you like a locked-in contract floor, or do you like SK Hynix spot market upside? Let me know your thoughts. And if you haven't done it already, make sure you hit like and make sure you subscribe to the channel. And I'll see you tomorrow after closing bell. Take care.